Hello, ladies and gentlemen, this is Juriaan Karsten and welcome back to another episode of our Let's Invest series. You are currently watching episode number 3. How are you guys doing today? Things are well from Amsterdam right now. The sun is shining, the weather is great. It's a beautiful Sunday afternoon. Thank you all guys for joining in today and let's get into it. Today is an interesting episode in which we have many things to do. So let's get into it right now. We will start the video off with a quick review of our portfolio as always. And we will be looking at the changes that have happened during the past days. After that, we will be taking a bird's eye view of our investment strategy. I think strategy is very important. In the past 2 videos, strategy was lacking. So I'm jumping into that head first, taking my time to really think about what am I going to do the next 10 years to set myself up for wealth and wealth creation. And finally, we will be taking a look at the portfolio asset allocation and the diversification that I have chosen. I want to pursue a lot of diversification in my investment portfolio. I think diversification is very important to, especially in these type of times, uncertain times, a discrepancy with the economics and the stock market. I think it's important to really think about diversification and the impact it has on your portfolio over the long term, especially when you don't want to lose that much money in downturns. But anyway, long story long, let's go into reviewing our portfolio. Welcome back into our Trading 212 account. As you can see, we are totally liquid at the moment. What that means is that we only are holding cash. Almost 4,000 euros is our cash position right now. We have no trades outstanding. As you can see, last week we had 2 trades. I can show you guys those trades right now. Those trades were Royal Caribbean Cruises, a cruise liner. I explained to you guys why I wanted to go in them. It was a very risky trade. Those guys could go belly up easily in this corona crisis, but I thought, well, they might survive, so why not buy some stocks and keep it for 3 years. But after I was looking at the market and thought, well, this can't be right. The economics are very bad. The market must come down. I said, well, I'm going to go out of this position at a profit. I did, and I netted more than 170 euros for that trade. Service Property Trust was another trade I did. A little bit more than 1,200 stocks I bought. Sold them also with a profit. I went out of both trades, made more than 300 euros within a week. I'm happy about those trades. But as you can see right now, I only own cash in this portfolio. So I'm not invested. This is not bothering me at the moment. The outlook on the economy is bad. And like I said before, this episode is not an active trading episode where I'll be reviewing let's say oil stocks and maybe get into an oil stock. Well, Occidental Petroleum is one of those stocks that got hammered really hard because of the oil crisis and the horrific battle in oil land that is going on between Russia, the Saudis, and the US shale companies, excuse me for that. No, this type of episode won't be about that. This episode will be more a bird's view eye of how do we look at trading, what will be the rules for which trades I will be making, and also my asset allocation. How will I look at that, and what type of asset allocation will I be choosing? So that this is more a strategic episode, not a hardcore trading episode where we're gonna think about making profits. No, not like that. So again, to summarize, I'm totally cash at the moment. Next week I will be doing some trades based on the rules that we will discuss later on in this episode. But today will be very relaxing when it comes to trading. So let's jump into the slides and I'll show you guys my strategy for the coming 10 years. Rule number 1, all the money I put into the portfolio can't leave the portfolio for another 5 years. You hear it correctly. All the money that I allocate into a portfolio or all the money that I put into my Trading 212 account, I cannot take out the account for 5 years. Yes, that is a very long time. Why am I doing this? I'm doing this to protect myself during weaker mental periods when I say, I think the market is down so much, I want to get out, I don't want to feel the pain anymore. No, I need to stay invested. Investing is a long-term thing. I shouldn't be thinking short-term, so I need to keep the money into the account. But what does this imply? Because it is quite of a large thing, to be honest. It means that I have to strategize about my expenses. We are all humans, so we are all living a life where we have to do some budgeting and we have to think about the big expenses in our life. If you're going to take an outlook of 10 years plus, which big expenses will you be doing in the next year? Let me give you an example of those big expenses. Buying a house, doing a wedding, or buying a car, for instance. Well, I thought about those things, and to be honest, I'm very lucky because I already own a car. I'm not going to buy a house in the next 5 years because houses are they are extremely expensive in Amsterdam at the moment. But I did ask my girlfriend to marry me, so I'm going to have to save for a wedding. That is going to be the biggest expense for me in the next 5 years. Yeah, again, so if you lock your money into the account, that means that you will stick out the hard times and you won't do any crazy irrational things. Rule number 2. This is a short rule, but it's an extremely important rule. This rule is about financial safety. It kind of is the little brother of the first rule, where I'm saying I need to have 6 times my monthly salary in the bank as a emergency fund. Yes, I think that is very important. Always have an emergency fund. Right now, I have an emergency fund of 6 months of income. I told you guys before, I own a company. I get an income out of that, like my 7 employees. The company is going okay right now, but still, you never know what happens in the future. It's always good to have a little pile of money somewhere for a rainy day. It's important because you do not need to sell stocks of your portfolio. So if I did not have the second rule in place during a really harsh time, for instance, let's say my company would go bankrupt and I would need cash to pay rent or to pay my car insurance, I would have needed to sell stocks, and I do not want that. Also, I'm not even able to do so because I have the first rule in place where I cannot sell, where I cannot take any money out of the portfolio. So because of that first rule, I need the second rule where I need a little bit of savings into my bank account for a rainy day. Rule number 3. This is one of the most important rules when it comes to investing and when it comes to my strategy for my portfolio. The rule states that I can never, even though that I make $1 million, I can never invest the total amount at once. I always have to do dollar cost averaging. And now you might say, okay, what the hell is dollar cost averaging? I never heard of that. Why wouldn't you just put your money into the stock market right away? Well, of course, that is a solid question. Let me explain. The strategy is called dollar cost averaging because, let me show you by drawing a line. This is the timeline. We start over here on the left side, and this is a 1 year of, of timeline, and the market does whatever it wants, right? Well, what if I told you that, for instance, I didn't want to get into the market at this point. I was afraid. I didn't want to go there. And then here I get FOMO and I jump into the market right here. Is that a good idea to go all in at this point? Well, not really, because probably after the market crashes on me and my portfolio is down almost, let's say, 40%, I might get a lot of scares. I might not be able to sleep at night because I feel really poor and I want to sell. How do you avoid all of this? Let me show you. If this is the market, when you do dollar cost averaging, You say, okay, every week, for instance, I'm going to do an investment and it's going to be the same amount every week. So what happens here? As you can see, well, I'm buying low, I'm buying a little bit higher, I'm buying at the top. Okay, well, that's not too bad. But the average of these trades is not as high as if I would have put all my money around here. Because I did a very cheap trade, another cheap trade, and, well, a decently cheap trade over here. So the average of these buy-in moments is way lower than the potential risk or the potential of buying too high. This is dollar cost averaging. It's all about adding up all these buying moments and then taking the average of all of those. And that is what's going to safeguard me of timing the market, because I do not want to time the market. I'm not good at timing the market. I've tried so in the past and I had a lot of luck there, but luck is not skill. So to save myself and to show you guys how I'm doing it with this portfolio, I'm going to dollar cost average and I'm going to put my money into my account every week. I've also made up a number that I can put into the account every week, and that will be 750 euros. Basically, if I don't buy any stocks every week, I will grow my account by 750 euros, which is a decent amount if you ask me. Okay guys, we just had rule number 3 in there. I'm seeing that the video is taking very long already, so I'm going to split them up into 2 parts. This is going to be the end of part 1. Check out part 2 to see rule 4, 5 and 6 and to understand the first 6 rules of our portfolio strategy. Thanks for watching and I'll see you guys in the next one. Have a good one.